Crafting financial resilience, the crucial role of asset allocation in a diversified portfolio. Introduction. In the symphony of investment strategy, the concept of asset allocation emerges as a conductor, orchestrating a harmonious blend of risk and return. The artful distribution of investments across various asset classes lies at the core of building a diversified portfolio. To unravel the significance of asset allocation, one must delve into the multifaceted role it plays in not only enhancing returns but also mitigating risk and fostering financial resilience. The essence of asset allocation. Asset allocation is the strategic distribution of investments across different asset classes, such as stocks, bonds, and cash equivalents, with the goal of optimizing the portfolio's risk-return profile. This dynamic process acknowledges that different asset classes exhibit distinct risk and return characteristics, and their performances may vary under different market conditions. The Portfolio Balancing Act. Imagine a financial landscape with two investors, each possessing $100,000 to invest. Investor A decides to allocate the entire amount to a single stock, while Investor B opts for a diversified approach, spreading the investment across stocks, bonds, and cash. Now, consider the scenario where the stock market experiences a downturn. Investor A, with an undiversified portfolio, bears the full brunt of the market decline. In contrast, Investor B, benefiting from the cushioning effect of asset diversification, may experience a more moderate impact on overall portfolio value. This analogy underscores the role of asset allocation in balancing risk and return. A diversified portfolio, through the careful allocation of assets, seeks to optimize returns while mitigating the impact of market volatility. Risk mitigation through diversification. Diversification, a key tenet of asset allocation, is akin to spreading risk across different investment avenues. The premise is that individual asset classes may respond differently to market events. For instance, during periods of economic expansion, stocks may outperform bonds. While in times of economic uncertainty, the relative stability of bonds may provide a buffer against equity market downturns. Consider a scenario where an investor holds a portfolio predominantly comprised of technology stocks. If the technology sector faces headwinds, the entire portfolio could suffer significant losses. However, by diversifying across sectors, geographies, and asset classes, the impact of underperformance in one area can be offset by strength in others, mitigating the overall risk exposure. Optimizing returns and volatility. Asset allocation extends beyond risk mitigation, it also plays a pivotal role in optimizing returns. Different asset classes have varying return potentials and volatilities. Historically, stocks have exhibited higher returns over the long term but come with increased volatility. Bonds, on the other hand, are often viewed as more stable but offer lower potential returns. Striking the right balance between riskier, higher returning assets and more stable, lower returning assets is at the heart of asset allocation. By combining assets with diverse risk-return profiles, investors aim to achieve an optimal blend that aligns with their financial goals and risk tolerance. The life cycle approach. Asset allocation is not a static concept, it evolves over an investor's life cycle. A young investor with a long time horizon may adopt a more aggressive allocation, emphasizing growth-oriented assets like stocks. This approach capitalizes on the extended timeframe to weather market volatility and harness the power of compounding. As investors approach retirement, the focus often shifts towards capital preservation and income generation. A more conservative allocation, with a higher proportion of fixed income assets, becomes prudent to safeguard accumulated wealth and provide a steady income stream in retirement. Market conditions and tactical asset allocation. The dynamic nature of financial markets necessitates a strategic approach to asset allocation. Tactical asset allocation involves adjusting the portfolio mix based on short to medium-term market conditions. For instance, in anticipation of an economic downturn, an investor may increase exposure to defensive assets like bonds and reduce exposure to more cyclical assets. However, tactical asset allocation requires careful consideration, as attempting to time the market consistently has proven elusive for many investors. While strategic adjustments can enhance portfolio resilience, a well-thought-out, long-term asset allocation strategy remains the cornerstone of investment success. Global diversification and currency risk. Asset allocation extends beyond traditional asset classes, it also encompasses geographic diversification. Investing in international markets provides exposure to different economic cycles, regulatory environments, and currency movements. However, it introduces currency risk, as exchange rate fluctuations can impact returns. Consider an investor who allocates a portion of their portfolio to international equities. If the U.S. dollar strengthens against other currencies, the returns from international investments, when converted back to U.S. dollars, may be adversely affected. Hedging strategies can be employed to mitigate currency risk, highlighting the intricacies involved in global asset allocation. Conclusion. In the intricate dance of portfolio construction, asset allocation emerges as a choreographer, blending risk and return into a harmonious performance. The strategic distribution of investments across diverse asset classes is not merely a theoretical concept, it is a dynamic and essential component of prudent financial planning. Whether mitigating risk through diversification, optimizing returns through thoughtful allocation, or adapting to evolving market conditions, asset allocation stands as a beacon guiding investors towards the achievement of their financial objectives. As markets ebb and flow, the artful orchestration of asset allocation remains a timeless strategy, empowering investors to navigate the ever-changing currents of the financial landscape with resilience and confidence.